Hello, guys and girls. Hello. Ah, I am actually really happy. Because I guessed right something on the Bitcoin, but anyway, today with the ETH sheriff because. We are going to find out a little bit about the fact that some of the actual um, stable coins that were on the sideline entered the market and got into if actually because of the announcement of the merge, the I think it is like the third, the fourth, the fifth, the sixth. Uh, I lost the count about that. Every time it got delayed, it got postponed, and so the last one is for September, the 19th September, 2022, and we'll see if the merge actually will happen this time or it will get delayed again. Um, it's on the test net actually. It's happening on the testnet, and developers are still working on it because they had problems implementing a lot of things. As you know, Ethereum has a lot of problems because they started the project as a proof of work, but they are trying to transition all the things they've done on proof of work until now to proof of stake, and that is a huge work. It's a deficit that they started with since the beginning, and implementing that will be hard. Actually, I am taking some time here, just explaining some things because waiting for someone to enter if they want, and seeing if anyway if you'll have any question or anything else. I'll try to cover the chat, but still on Sunday evening on summer I get that there isn't much people around talking about these things. I'm here anyway because I'm a little bit more I don't know, nerd. I really appreciate the time I spent on here, watching charts and everything else. Anyway, let's just get into what I want to talk about today. Today I want to talk about Bitcoin. I want to talk about the fact that we're in an area where probably we'll see a lot of volatility in the next week, or at the end of the next week anyway. And we're covering the options, on-chain metrics, macro environment with the DXY and the yield curve control, and what will be the outcome of the Fed. So stay here to all of this because I'm trying here to explain the whole lot of this. Probably I'll get into the macro at the end, so if you are more of a macro finger, you'd get to the end and seeing where it starts. And I'll try to make stamps on this video, so you'll get to whatever you want to see in an instant. Okay, the other one I just let it go, but so let's get it on here. I'm starting with Bitcoin. So as you see, we are in an area where the price is actually comprised between this two trend line. This trend line are our resistances, our huge resistances, and whatever you think of, these are the actual resistance of all the market itself. What could mean that we break, for example, this trend line right here? We're now on Coinbase chart, so it's a little bit different from the Bitstamp. You should watch and care about more because it has more history behind, obviously. But just because I have a lot, as you see, I have a lot of charts, I'm covering it like this, and as you see right here, we are in an area, and I use more likely this chart here just for the Bollinger Bands. We're in an area where we touched and tested this resistance right here, and that we are actually using as a resistance since 28 March 2022. Okay, this is more likely 4 months of downtrend, continuous downtrend on the Bitcoin price. And every time we did in fact drop below, it was when retesting this area right here. Okay, and every time we tested that area also, we were in an area of volatility from the Bollinger Bands. So for me, that's huge. That's a huge thing to know, because as you see, every time we were in that area, we got 9, 10, 11k movement to the downside. But what if this time we get to have a break of this trend line and we get an 8, 9, 10k to the upside, like a rally that we could have in a bear market, a huge rally with short squeeze and this huge movement, because we are still here. It's a month now that we are still hanging out on the 20k level, more or less, up and down, that is, and we'll see how on-chain data relates to that in a bit. But as you see, we're still here in a month, and when the time comes, with 1 month of price action, narrowing the price, narrowing the volumes, narrowing the actual expectation about the fluctuation of the markets, and derivatives markets are continuously accumulating people that are longing, shoring, and when a price movement will be out and the price will start to move, breaking things like shorts or longs, the movement of the price will be as of like this. In a few days we'll go down or we'll go up, for more or less as we did still 10k. In this case we need from 5th January to the actual 22 January, so we got 2 weeks, but most likely 1 week is needed for the price to move so much. But in just a week we could have the actual price go to levels where we are actually seeing next in this video. So what will be the actual movement, and what if the actual price of the current price of Bitcoin was not enough up to make the move upwards? And what could be the point where we have resistances and we have supports? Let's see it. So let's get here. I was watching if in the chat was something now. Here we have some clue to the actual resistance zone we have above. If we break down below here, we could very well retest this area. As for just the price action itself, with resistance, basic resistance and basic support zones. Okay, we have the resistance right here at 26.5k. That is the last week we had 13th May, and 28.5k. That is the lower bound of all this price action we had for a month there. Also, the top of the price action is 31.3k. To the downside, this is actually, those instead are actually the support zone. 18.2k here with the last week retesting, 17.1k still in the same zone, and also 15.6k, 15.5, that is the Fibonacci 1.272 retracement level. I did in fact put an analysis here. I'm not going through this analysis right here on my ChainLog school, but it has as of it right now, we touched the 1.132 when we got to the upside, and we are going here to touch 1.1.32. We did in fact touch it, and if we go below, that is the level that will be touching. And also another level, that is the last level, I think I call the bottom area, as you already know, on June 14th, this huge demand area. And I was calling for it because everything calls for it, every data called for it. I was not, it's not myself, it's not that I called it, it's that the data called it, because 8 metrics out of 10 was actually calling the bottom on on-chain data, and also on technical analysis side, and even if the news was bearish, there was no hints on the price going down again and down again. That's instead the actual the current situation that we have right here. Now we have some kind of resistance zone, some kind of pattern that could have the price led to the 14k, or the last resort support that we have right here. That is what I was thinking. And so instead, if we break above this trend line right here, and so if the price keep grinding up and close at 21.6k, for example, it will be breaking this trend line, and will be probably have a huge short squeeze to the upside, or just a retest of the trend line here before having a movement to the upside. But if we kept trending below and we fall like this, and we close like 21k today, we're seeing if tomorrow with the openings of the stock market, this kind of movement will be pushed back to the downside, retesting this area, and let us experience more days before it actually breaks the trend line. Okay, so still using the resistance for a little bit, as we did right here. We touched it, we retested it at the very end, when the price didn't get up, didn't have the power to get up, the strength to get up, we fell below. So this could be the actual pattern I see here, but also you could put in that we had in fact we are in fact at the price where, if we close the weekly right here, we'll be up this trend line right here, and we could retest the 20.5k next week, so 7 days long, to retest the 20.5k as a support, so even touching the 20k and getting and close maybe above, to retest this trend line right here. and we'll see if that is enough, because if you watch the monthly chart, we did in fact retest exactly the lower Bollinger Bands and this trend line right here. So if we did if we do manage to do that also on the weekly chart and on the daily chart, that will be huge, and that obviously will mean that we'll have that price appreciation that will lead us to the upside right here. Anyway, that's what I'm thinking about Bitcoin right now. This is not obviously financial advice, this is just educational purpose only content, but I will not repeat it. If you have any financial, if you want any financial advice, this is not the place. I'm not the kind of guy. I'm just an educator, and here you'll find what I'm expecting from the market. This is just my opinion, and you should not be engaging in any financial transaction and any financial decisions. You shouldn't made any financial decision with what I think as a background of your movements. Anyway, here I finished. We can go on Ethereum. As you see, Ethereum got straight up as per the things I said in the introduction, and Ethereum with the merge 19th of September delayed 100 times. We'll see if this time will be correct, but what we saw is that the USDT and USDC dominance follow swift down, entering the ETH itself and not the Bitcoins yesterday that instead helped Ethereum get up. So we had Bitcoin swapped into Ethereum on the Ethereum Bitcoin here that had a huge amount of movement up, and that what I was so happy about, and that's why I have this Ethereum because I actually made a lot of profit there. And also we have seen USDT and USDC getting into from the sideline, getting into ETH. We'll see if this actually plays out like I think too, and we'll see huge price appreciation on the if we get to have the price appreciation of the Bitcoins itself. Probably we'll be seeing the ETH Bitcoin getting up again. So too we in the opposite we'll get to retest these areas right here. If we get down below to 14k, probably the same will happen, and probably still the ETH will retest 800k, 800 and 600 price supports, because as you see right here, those are actually the very last support we had before the bull started, and also the top of the previous after and before the actual top of the 2017 market. So another thing I was watching today was the crypto dominance, that is all the dollar pegged, the dollar denominated assets, so Bitcoin, Ethereum, and all the other crypto assets, and comparing that to the stablecoin dominance, that is all the actual. It's better to say the dollar pegged assets. So we'll call stablecoin anyway. Dominance, that as you see, it's I already talked about that in my study case, but we're seeing that diminishing a little bit, getting like a bull flag right here, but still increasing into the overall. That means that the investor sentiment is not is still not more versus more towards the risk on assets. Still seeing risk-off environment like a possible safe haven for now, and you can see it right there also, because meanwhile in the bear market 2018, 2019, 2020, we got the crypto dominance getting up, so stable coins was used, and also in that case real money was used to buy the crypto assets, and so pushing their dominance up. In this case, we're seeing that creeping downward because of the fact that we have seen so much of the stablecoin dominance getting up as a result of the risk-off assets environment that investors are more likely to act to. And as you see right here, as you see, instead we get into the last bear market, less and less stable coins. Meanwhile, in this bear market, we are seeing this increasing in stable coins. In the last bull market, we had a huge amount of people entering. So we got more stablecoin dominance because of the fact that more people was entering the market. But here, with less and less people in the market, we are seeing this kind of movement. Is the only thing I come out about this is just the investor behavior, or the behavior of the investor on the risk of assets. And as soon as I'll see this stablecoin dominance getting down to probably a level of 20%, well, probably out of the bear market already, and we're seeing huge pumps in every single crypto asset. That is the same level we used as a support, and as a resistance, and as a support in every circumstances. So I'm watching that 20% as a level where we can actually confirm that we are in a more risk-on environment than before. And so probably the bottom will be already in, and will be priced in more likely right here. If not, we'll see, because it's not the first time that we had more than 30% of stablecoin. But anyway, I don't want to get too long on this. I just wanted to make you know about that. So for the derivatives now, we are seeing that options for bitcoins that closes at the end of this month, that is the major the major open interest and call option and put options, are actually closing at the 29th of July, and there is a lot of calls, a majority of calls that is not majority of calls instead of puts. And as you see right here, we have the actual options accumulating, the open interest accumulating on the sides, but still not in the same spot we got last time before the actual breakdown. That is the 23, 22, 24 of June, 23, 24 of June. That was June. More likely here. When it closed down, it was pricing in already all of this drawdown, because most likely people do not expect and do not wait for the actual strike price, but they start liquidate some option before the actual strike price is eaten, because obviously they don't want to lose money. So in this case, we're talking about the expiry date of 29th of July. And as you see, we have a call option strike price ranging from 22 to 24k, and open interest on until 30k. That is that the market is pricing in for the end of this month a 30k Bitcoin. Let's take it 25 to 30k Bitcoin, so more than 20, 22, 24 Bitcoin at the end of the month. And put option are actually pricing in instead 14, 15, actually 15 is the major open interest on that, with a strike price of 20, and they're pricing in at the end of the month at 15k Bitcoin. So the actual price we already talked about, and the Fibonacci level we already seen. And this is just useful for me to assess if the market is bullish or bearish. But as you see, we have more call option than puts, and that is for me, if we watch the entire expiry date, that is for me, I can read this as the market is more bullish than not, actually. And you can see it also on the VIX that closed at 24.2, and that is a slow drawdown from the last 35 local top we had. That means we are more bullish than bearish. Actually, getting to a level of safety will be below 20. But it is on 30 actually on the VIX. That is, the VIX is obviously the option, the sentiment of the market that takes in consideration the forecasts of the options of the S&P 500, and so it's a little bit more complicated to actually explain it. But let's take it as a sentiment indicator, where the 30 is the actual the current bearish value, where fear is in the market. Meanwhile, below 20, there's actually greed more than fears, okay, into the market, and there are more calls than puts. Meanwhile, here there's more puts than calls, essentially. And this is what I'm talking about here on derivatives. That's what I think it's useful to see and know about. For the on-chain data, we actually retested on the ASOPR. We actually retested the 1 level. That means that we are in a zone on the on-chain that we are actually retesting a level of resistance. Because in bear markets, ASOPR, that is the spent output profit ratio, adjusted so that it doesn't takes in consideration coins with less than 1 hour lifespan. Okay, so it removes the noise. The ASOPR is better for me, in my opinion, that the SOPR for this reason, because it removes the noise. And as you see right here, we are testing that area of resistance that in bear market we see every time. The prolonged SOPR below 0, it's a lot of every time we get into bear market, we have this retest every time of the 1, and every time we get to the 1 level, we get rejected and continue getting down. Because market participants are actually taking the possibility, the opportunity to get out in break-even points as a whole, and as soon as they can. And 1 is actually the break-even point on this metric for the entire market, of the profitability of the market. So below 1, we are actually seeing the market selling at a loss, and above 1 we're moving. Let's take into account that we're instead selling at a profit. Okay, here we're actually, obviously, is on chain, so coin moved on chain at a loss, coin moved on chain at a profit, and every time anyway we touch that, it means that in a bear market we are seeing, as you see, every time for a huge amount of time, we're tested the 1, trending a little bit above some time, but still getting down and down again. So we are still in an area of resistance, and if we make so, this is just another bearish indicator for me, for this price action that will not be able to break this trend line, even if I'm praying to, because I I like the price to go up like everybody, but that is a bearish indicator to me. And anyway, that is just for the short-term view, because I'll be entering obviously below, but this is not an argument that I'm making here. I share my portfolio, my strategies, my buys and my sells on the actual ChainLog chat, so I cannot do here. Today I want to talk about also from Onchain. Here we have this resistance right here, that is our huge resistance, that is short-term holder realized price. Short-term holder realized price is the cost basis of all short-term holders, or i.e. the actual the current people who are holding for less than 5 months. Meanwhile, long-term holders are more than 5 months. Okay, to be short, and the cost basis of them is actually 28.6, and that is kind of important for us, because as you see, this metric was used a lot as a resistance or as a support every time in the history of Bitcoin. So I'm seeing that 28.6k as a resistance. That could be also the actual lower band of the last accumulation or distribution zone. As we could see it as a distribution, even if was accumulated something. We got the Celsius thing, and a lot of whales will get flushed. Was flashed away. Were flushed away, and instead we see that long-term holders realized price, the cost basis is making us a support right here, and it did also in the COVID crash, but also we had that two times when we fell below. That was a huge opportunity for the market, and still not financial advice, but my opinion, in the longer run, if you get out this short-term movement, if I should decide to buy here or wait for the price to get lower, I will decide to buy here, and maybe at the very least just hedge myself in the case of that going down, the price going down. Maybe with some edge, you can put puts, for example. You can buy puts. You can use some pair in a certain manner, so that you can actually hedge yourself better. You have a lot of instruments actually to hedge yourself, and I'm not taking the chance to get lower. And maybe losing the one we are here at 20k, and when I think that Bitcoin for me it's just 1 million a coin, okay, that it's my valuing, or half a million anyway. So 20 to 12 a million, it's a lot. It's a lot. It's a lot for me. I don't know for you, but for me it's actually like a lifetime of it's a lifetime of worth. Okay, another thing I want to talk really fast about is that we are obviously in the same perspective, long-term perspective. If you take out the short-term noise, we are actually below the 200 weekly EMA, the 200 weekly SMAs. That are these two lines right here, and that happened not very often. As you see, we used along most likely all across the history of Bitcoin as a support, and now we are below those. And I would not take in consideration. I would not take the chance that we go lower and lower again. Just me, it's my opinion. Maybe we get another flash out, we get other bad news, other things that, but I don't know. These resistance zones will be huge, so we're not going to, and we'll get to 14k. It doesn't really matter in the long term if you buy at 20k or 14k. It doesn't really matter in the long term. It really matter on the short term. If you want to make a profit, like what they say, in 1 year, 6 months, 1 year, in 10 years, if Bitcoin gets to 500k, one took at 20 and one took at 14, it's more likely the same. It's not very much. If you lose the opportunity there, also instead, that will be a very pain to see the price getting so up, and meanwhile you just watch it getting down and you didn't buy it. And we also we're also below the realized price, that is this line right here, 21 and now 21.5k, still declining. And 21.5k, if we manage to get above that, that is a resistance also there, so still short term we are actually bearish for the price action, but praying for the price action to get up, because we have this resistance right here, the resistance from Super, resistance from the trend line right here, resistance from the Bollinger Bands. We got the RSI 50, as you see right here on the daily chart, as a resistance, and we have also the 26 EMA as a resistance. That is our short-term valuating SMA, EMA, to see if the short-term trend changes. Okay, that is the monthly EMA. So we have a lot of things to be scared about in the short term, but in the long term, that we are in an area where we should buy, and that is obviously my opinion. That is not financial advice. My lowers will be so much happy about what I'm doing right now. Repeating all of that. And beside this that I talked already, is that was a lot of UTXO moved, but not a lot of coins. Just a lot of people scared about the actual that was the food for the exchanges being insolvent. So people withdraw from the exchanges, even if they had 0.01. Okay, bitcoins, they withdraw from the exchanges for that fear. Where's that the average spent coin, the average spent output lifespan, that is the ASOL, actually takes in consideration only the UTXOs move on chain. So we are seeing that this metric just moving with the number of UTXOs. So if you don't have the notion of UTXO, this metric will not be so useful for you. You should watch and care for that, because it is important. I am actually making a course about on-chain data. When it will be out, probably will cost much more. For now, it's still free, because you have 7 days free trial on the ChainLog school. And until I have finished all my courses, there will be with the price of the services there. And I talked about that. And this is Coindays destroyed anyway on-chain metrics, so it takes into account the days destroyed in this case of the UTXOs, not the actual coin volume. For the actual coin volume, you get dormancy supply adjusted, that is supply adjusted in comparison to the circulating supply. So that meanwhile the increasing of coins, the increasing of coins in the circulating supply are higher, because they are minted to pay out the miner fees. It takes into account that, and so that the floor doesn't raise too much, and you can compare. The dormancy is actually comparing the weight is weighting the coins, the volume of coins into the coin that is destroyed. Dormancy is actually a measure of the lifespan of a coin before it actually been destroyed. So as you see right here, we're just moving lower and lower. We're not seeing valuable information about long-term holders getting out of the market. We're still seeing a lot of day traders because the actual the current thing, the important things to notice about that dormancy flow, Bitcoin days destroyed, is that when we have these huge movements in coins, that means that we have a huge amount of older coins being moved on chain, and so we can guess that if we are on the top of the market, we'll be probably putting a top. We're on the bottom of the market, that will mean capitulation, and we're not seeing that. We're just seeing this metric decline with long-term holders just getting out of the market, hodling, and not speculating. We are not seeing those hodlers selling. That is huge for us, because we know that still we didn't show any capitulation, but we didn't have any on the 2015 bear market. So that was an actual this one was actually just a case of itself, because I was there, and we all thought that Bitcoin was going to die. I just kept hodling, and luckily I got I got to this point right here. Anyway, we're seeing that long-term holders are not getting out of the market, and dormancy flow that is taking into account the same thing of dormancy here, but with the capitalization, the market cap divided for that, because when you divide by the market cap, you have a gauge of the bottom and the tops, because now the metrics goes with the market cap, with the movement, with the price. You see that we had in the last bear market the less than a half of the actual value we have right here. So still, this is a metric that didn't bottom, and I don't know if I'm expecting it to bottom, but it was worth mention that this is something that I was watching too. Obviously, it didn't bottom as the previous bear market, but still it has bottom. If you think about the overall, if you take this line, for example, right here, you see that it actually touched the bottom, and we are there into the very bottom of the bear market, but not as much as we had in the last bear market or in the previous one. That is obviously because still coins are being lost, still others are getting more hodlers into the market. We are having more hodlers than the last bear market, so there is not so much of movement of coins. People still hodling their coins more than the last bear market, and we're seeing that behavior rising and rising again and again. I'm not taking this because I don't want to make publicity. I don't want to advertise, so I'm get out of the screen just to drink. Because talking for half an hour or more, 1 hour, it's a lot. And MVRV crosses right here is another metric that didn't bottom yet, and that is the long-term holder MVRV and the short-term holder MVRV 1 week MA crossing. And every time the long-term holder MVRV, or market value to realized value, also covered in my on-chain analysis course on ChainLog, is below the short-term holders we were in an area of bottom every time we did in fact bottomed out there, and we kept trending higher from there on. And that is another metric that it was worth mentioning because it's important for me. Still, long-term holders are in profit. Are the 49% of all long-term holders are in profit. Meanwhile, 20% of of them are actually in loss. 20 The short-term holder in loss is 13% of the overall of the overall. Let's take into account everything here. It's 13% of the overall 100. So we are seeing that 13 plus 8 is like 21% are short-term holders that are actually into the market. Meanwhile, the majority is still hodled by long-term holders that are still in profit for 50% of the overall supply, and are actually hodling still even in 28% of the supply, even if they are in loss. And that's good to know, because as you see right here, every time we had this kind of huge drawdowns in long-term holders in loss, we were actually in a bear market with the short-term holders in loss. That was actually that were more likely to the zero. Okay, that you see yourself that is more likely the same behavior every time we get into the bear market, where long-term holders are getting in loss, and the short-term holders are actually being destroyed and got all the way more likely to the 0% of in profit themselves. It didn't happen here, but still there are differences in the kind of holders, in the kind of daily day traders that we have in the market. We have now day traders that are investors, net worth investors, people, protocols that know what they are doing. So in the everyday day trading, we have bots, we have algo bots, quant bots, and so probably we're not seeing anywhere near the 0%. Just because of that, we had even if we had sometime reached the short-term holders in profit that was 0.68%, and here, for example, 1% of the overall supply. As you see, that is something that has some similarities in it, and I would like to cover it. In realized profit distribution, as you see right here, we are not seeing a lot of realized profit being realized on chain, if not from coming from these day traders, 1 day to 1 week. Also, we do had some occasional move of coins that was 4 to 8 years. That was occasional. That likely was occasional on the 2 to 3 years here, there. It was nothing really that matters. Instead, what that matters is the realized loss that we had. People that were into the market since 1 or 2 years, or 6 months to 1 year, that is actually realizing still a loss on chain. That those are people not to be considered long-term holders, because they entered probably right here or right there, and still they are still in the same spot. They are still there. They entered here because, as you see, still or here, and they can take in this kind of pain, and so they are selling at a loss. that those are not, as you see, you do not have people that or hodlers that have 2 years to 3 years, 3, 4, 8 years selling at a loss here. It's more likely all day trading or short-term holders that are actually driving the market down, as always. And just in the last period, we had this a little bit of those that didn't take it in anymore, or they're just betting on the fact that they can buy it more below. Okay. That's useful for me because obviously this is long-term bullish. When this sell pressure will be exhausted, we'll have those long-term holders realizing all those profit. And as you see right here, let's cover it just a little bit. Handbags are actually on the these are the address count balances, so the balances divided by the number of coins the wallets had. And as you see, handbags are actually more or less in the same zone, but they are keep stacking since the last all-time high. They are kept stacking even with some drawdowns, as of right here, for example, also. And they keep stacking the sats all the way up. Whales are instead getting down, and those are probably the protocols, the companies that were over leveraged and got flushed out. So as for the Luna Foundation, for example, and Celsius, Voyagers that we're seeing today, that they are getting into the bankruptcy procedures. Also sharks that are probably investors on the same platforms, or founders of people, high net worth investors that drove down the price just like there, for example. When we got that last drawdown, that was covered by the sharks. But the actual buy pressure, and that I want to talk about, is actually that the buy pressure will come from the very base of the Bitcoin market, of the Bitcoin hodlers, of the market participants, the retailers that are keep on stacking since the very drawdown we had. And most likely, meanwhile we get down here, we are keeping stacking sats all along. Here fish are actually time the top, for example, that is 10 to 100 bitcoins. They behave more likely like me, and they did in fact spot the top right here and start getting out of the market. And I got that for luckily I got that on 60k and 60, 67, 63, because I was already seeing that happening also here at the same price level. We didn't have so much on Onchain that pressure about new activity, so I was sniffing that. And I got out. Fortunately, I started buying from 30k. Since now, I'm still buying. And as you see in the last period, as we got that flushed out on sharks and on Celsius and all other protocols, we got this huge getting up. And crabs and shrimps and plankton, just they didn't care about. Shrimps also do not care about the price itself, they just kept stacking. Crabs more or less also, okay, they just didn't care about the price. These are probably also maxis, and people just take their DCA into action. So this buy pressure will at a certain point lead to this sell pressure being exhausted and this buy pressure to take over, and that will lead to the next bull run probably. So let's take in consideration the last argument of today. We got the macro to cover. As you see right here, we had the S&Ps and the Nasdaq, the Dow Jones. All of those were getting higher, and the market was actually hyped by that. And what did it move so much? Why so much? We had a 50% increase in the stocks on the S&P 500 that was actually getting above the 50-day moving average, and so much of the 200 moving average also getting above. That is because we had the retailer sales, the new retailer sales value, and these are actually increasing. Okay, let's take this percent change from the last month. Okay, and we take this as a percent change from a year ago. Okay, so as you see right here, we have this a little bit stepping up. The retail sale is stepping up on as a percentage from the last year, and month over month we are in the same spot, but with a momentum that is decreasing. We are actually seeing a little bit of a raise there, but the momentum is decreasing in reality. So people watched that and thought about we have these retailer sales that is trying to keep up with the market condition, with the economy. But this is not quite true anyway, because probably people is so desperate that a little bit of opium like this can lead to something like those movements to happen right here. But if you take in consideration real closely the numbers, actually the momentum is decreasing, and we have the last print month over month minus 0.27. So we are still not very there. And if you take in consideration this and you get out the CPI, okay, that we had. So to speak here, I don't have the last print of the CPI. That is anyway. That is 9.1%. Okay, if you take out the 9.1% from the CPI, and you take retailer sales, inflation adjusted, you'll get anyway near a 2%, 2.1% less retailer sales. So actually they are not keeping up with the actual with the current inflation, nor with the current economy, and they're struggling, and they're very much struggling also. That was also helped by I don't know if TradingView just got the update from that here. I didn't care about watching too. No, we got anyway a little bit of the last print of the Michigan University. We consumer sentiment, we got a little bit of an uptick. Okay, so we got a little bit up. So this coupled with the retail sales was actually hyping the market, but as you see right here, we are the lowest value ever. So I don't know how much could be helpful to see about something like that for a recession to be finished, or anyway to be in that area of having the market to finally have a rally. I don't really know if that matters. I don't think this is quite useful anyway to assess a market rally. For me, we are still in the same situation, in my opinion. But let's get to the very important and lastly thing that I want to talk about today. That's important. So let's take it to the DXY. Okay, from the DXY you see that we are trending higher ever since we had these rate hikes from the Fed. This is because obviously we had the yield curve control on the JPY, that are the BOJ, the Bank of Japan, are actually buying and buying and buying their let me get it too, their bonds, their 10-year bonds, the JGBs, obviously JGBs, Japanese government bonds, 10-year yields, and trying to get this, to let this level stay at 25 bps. Okay, so they're actually selling their JPY to buy bonds, and they're actually they're currently are in possession. I watched the last data was 70% of their government bonds of their government, and they purchased all of that, and still trying to get to have this 25% BPS put in. So every time the market is pushing up the yield, selling the bonds, they're buying the bonds and selling the JPY. That leads to the dollar being strengthened because the DXY is actually weighted more to the JPY and the year as a counterbalance of the DXY. Okay, so we have this DXY. I'm talking a lot. So we have the DXY is actually weighted for year and JPY mostly, but also other currencies. Okay. So what I'm talking about here is that in fact we are actually seeing the eurozone, in the eurozone, the ECB doing the same with their last instrument, and with their last instrument, the anti-fragmentation tool, they called it. They are actually selling they're taking the yield from the bonds of the German, for example, bonds, and to buy the debt of the states that are in debt. So to speak, Italy, Spain, Greece, and that is the exact same thing is doing the Bank of Japan, is yield curve control. They are actually trying to control the yield curve of the bonds of the states they are in. The problem with the obviously with the European banks is that they don't have. I am in Europe, so we don't have a common financial place. We have more financial districts all over the eurozone. We don't have a unique financial place like in the US, where there are countries, but they share anyway one unique financial market. That is not the case for the European zone, where the ECB is actually trying to yield curve control the spread between the bonds from Italy and German, so that the system doesn't collapse on the next tightening. They are going to start. That was in July, but I don't know if they are actually going to tighten very much, and the market is already pricing in that, because if they tighten too much, probably the collapse of the very in-depth countries. I think that Italy has like 170% of the GDP to debt to GDP ratio, and that's a lot. If they try to move up the rate hikes more than 25 bps, they'll defaulting and bringing the snowball effect to all the European countries, leading to a disgregation of the eurozone, and that they don't want to see. So they have to put in place this last anti-fragmentation tool to yield curve control, but this will lead the euro itself to be weakened. As for the fact that they could print money just to buy the instead of taking the yield from the German. They're printing, probably they are going to print money to buy the higher yield, more risky bonds of the states that are actually going to default if they raise rates too much. And that will lead, with the year, with the JPY waiting so much with the DXY, to a DXY increasing, obviously. But what, and here I'm going to make myself only face. So what in the hell, what happened if they cannot continue to do that? Because obviously they can control then all these things, but to a certain extent they'll need, with rising cost of inflation, they'll need cost of money. There is rising cost of money. As for the inflation, there are supply chain issues that European are and actually still Japanese also are experiences for energy costs that are increasing for sanctions, because they are allied with the USA, because they have to follow USA's orders to stay allied. So with this rising, with this increase in costs, they can't keep up, and so they'll need an help. And I read an article from a guy that is actually, I think that his name Arturais. I read an article where it breaks down all the things, okay, and he talked about the fact that Japanese are actually buying in this 0.25. That he talked about this the methods on why the Bank of Japan can't let the market price in more of 25 bps on the 10 years JGBs, and so actually what I'm trying to say here is that they are going to try to get help, probably from the US. And follow me closely here. Follow me closely. So, if they try to find help on the US side, what can the US do for their allies in this situation? They have a production, an internal production of energy. Okay, they have a lot of natural gas. They have oil. They have anything they need to overcome the sanctions from to Russia. But Europe and Japan do not. To help them, and they can. They could. I don't know if they are going to, but they could, and the market is trying to pricing in that also. Even if it's hard to price in that, they could buy. So let's get this out. Meanwhile, they are tightening their internal economy. They are tightening. Okay, they're raising interest rates, the Fed funds, and meanwhile they do that, and they're trying to lower in demand, raising unemployment because of the supply chain issues they can't control directly. Okay, with the reverse wealth effects and everything else. The other side is that they could print. I know it sounds crazy. They can print USDs, so they can print dollars to buy European bonds and Japanese bonds to help those and relieve those overweighted countries from their debts. Okay, So easing meanwhile tightening, okay? They could ease meanwhile tightening, and this could lead to obviously a 0 point effect where the tightening will be useless, but they could help in the same manner at the same time the other states. So as you see, it's complex, and why I'm talking about that and why we're taking in consideration this fact that could happen, because let's get right to the chart again. Because on the DXY, we're obviously at a very is still strong, but if the market is pricing in that, we'll probably seeing this kind of 100 110 DXY staying right here. Meanwhile, the market is trying to assess the impossibility of this the actual the brain destroying of this monetary policy. Okay, and if it will be confirmed, if this will be confirmed, obviously the market will be pricing much more the fact, and probably will see the dollar a little bit of decline or staying in this area a lot more. And so the market could have a recover from that, not just because the dollar will decrease, but just because it will stay right there. Okay, and staying right there by pressure, that in this case will not be overloaded with a stronger dollar from Bitcoin and in any way indexes in the stock market, could lead to a first relief rally that in the disastrous case of these monetary policies that will not go well, and we are going to see the dollar decreasing. Obviously, we'll see a huge market movement to the upside. But still, this is the fact. We are pricing in this kind of policy from them, and that is what I want to talk about today, really much. I could go more into the GGBs, because you think about that. I read that in the article, so I can explain to you. They can't actually make so let's make here on the only face. They can actually make so the Japanese sell their keep selling their bonds. Let's make an example. You have I'm not so much in the fact, because this was actually people with experience on the JGB market, like 40 years from now. So you should carefully watch and search for that article from Arthur Ayes, because it explains a lot of things. And anyway, if you have Japanese, go to the bank, making an example, and buy a certain product at a fixed income, fixed rate. So they lock their money for 1 year. If the price is below, if the yield is below 0.25%, they locked instead 20 years. If the yield is more than 0.25%, they'll be locked. And the bank actually will gain the profit from that higher yield. Okay, the difference from their higher yield. Meanwhile, their customers are actually taking only the 0.25% all the 20 years. What happens then if someone actually get to that level? If the price rise more than 0.25%, Japanese people will have will be found in a situation where the cost of living is rising, the cost of energy is rising, everything is rising from inflation, and they'll need those money back. But 0.25% in the case we are getting higher than that, and the yield curve control doesn't get into place. They're actually found themselves having 20 years locked capital, and when they are actually going to ask their bankers if they can exit their position to have their money back and to actually pay for this rising cost of living, they say obviously, well, yes, but there will be a price to that. And actually, if you take in consideration the movement of the bonds, I'm not currently going into that. But if the yields raise the actual cost of the bond, the current cost of the bond, the bond values goes lower. So if you let's make an example, you bought 100 face value. I'm not taking into account obviously the coupon and everything else. You bought a 100 face value. If you sell at 0.70 at $70 value, obviously you lost 30% of your capital, and that is because the yield is rising. Because if you have the face value of 0.25%, it's increasing actually. Obviously the value of the bonds goes down, and you'll have if you sell the bond at that price, you'll obviously have that that loss on your portfolio. So you have a rising cost of living, the need for the money, and you'll get priced 20 to 30, I don't know, in depends obviously when you're actually selling, to your amount being locked, and that could lead obviously to a very large amount of problems along all the system, and they can't manage to do that. So we are at the end today. I talked a lot. I very much talk a lot, and I maybe this you found this useful. I will be very grateful if you find this useful, because this is what I do every day. This is what I research. This is what I do on the Taylor School. Also, I'm covering bitcoins every day with the indexes and all of that, and that's what I like to do. And I find that helping others it's what I'm in for. Obviously, this to get me prosperous, maybe getting others prosperous. I don't know if they can. The more prosperous we are all together, the better. And anyway, this is it for today, guys. Make a like or subscribe to the channel, share this live, follow me on Twitter. I'm there also. I have a Substack, so if you want, you will have the free alpha, just the alpha, without anything else that I share on Twitter on your email. So you can subscribe there. All the links obviously are in the description, or on Twitter, wherever you want. And just share this. It very all you do, making like, subscribe, sharing, commenting is helping me and this channel to grow and reach even more people, to help out even more people. As you see, I share this information for free. I don't want any I don't want any money to do that. I'm just taking the possibility to do courses and more in depth. That is obviously on payment, but if you are already in the situation, you can always follow me and ask me question. I'm very open to reply any question you have. So this is it anyway. I hope you enjoyed this live stream. I'm going to end it right now, and we'll see you next time when I have more to speak about, probably in 1 or 2 weeks. Okay. So this is ChainLog Analyst here, guys.